stock chart for the Nasdaq today, it does not look like a financial metric. It looks like telemetry data from a rocket that was plummeting toward the Earth, only to fire its thrusters at the absolute last second and just shoot straight back into orbit.
Oh, absolutely. It's the absolute definition of market whiplash.
Yeah. We're talking about a staggering 1,100-point turnaround in a single trading session.
Yeah.
If you were watching the screens, it was blinding red 1 minute and then a violent sea of green the next.
Yeah, you have these massive violent swings that just completely defy standard technical analysis. We're watching an entirely new paradigm of volatility play out right in front of us,
Right.
where, macroeconomic data and geopolitical shocks are just colliding on an hourly basis.
Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Before we jump into the madness, just a quick reminder for you listening. This deep dive into our sources is strictly for market context and discussion. We're here to break down the mechanics of the market, but this is not personal investment advice or a recommendation to buy or sell anything.
Right. So let's establish the baseline for today. Thursday, July 30th, 2026. A massive relief rally just swept through U.S. equities, miraculously recovering from the tech-led bloodbath of the prior session.
Which was brutal.
It really was. We also saw the U.S. dollar weaken significantly, closing at 99.98, and crude oil, just extreme volatility.
Yeah, but Brent crude spiked all the way up to an intraday high of $93.14, right?
Exactly, before sliding all the way back down to close at $89.45.
So today's deep dive is going to break down exactly how this happened. We're going to look at the crucial economic data that dropped this morning, some truly staggering AI spending numbers that essentially saved the tech sector, and the geopolitical shockwaves driving these massive, terrifying swings.
Yeah, because to really understand the sheer scale of today's turnaround, we have to start with the incredibly grim setup from last night.
Which brings us to our first segment, Session 1. What set the stage before the U.S. session?
Well, the context from July 29 is crucial here. The Federal Reserve had just held rates steady at 3.50% to 3.75%.
Right.
But, it wasn't the hold that spooked the market, it was the commentary. Chair Kevin Warsh delivered a distinctly hawkish message.
He effectively told the market that the Fed has zero tolerance for persistently elevated inflation.
Yes. And he completely dialed back on their forward guidance.
And, when a Fed chair removes forward guidance, they're essentially taking away the market's safety net. Institutional portfolios operate on predictability.
Exactly.
So when Warsh introduced that uncertainty, tech stocks, which are obviously incredibly sensitive to interest rates, they just sold off hard, and the S&P 500 closed near its absolute lows.
But a hawkish Fed was really only the beginning of the nightmare scenario. Overnight, the geopolitical map basically caught fire.
Let's look at the timeline from our sources, because the sequence of events here is intense. Just after 7 p.m. Eastern Time last night, the U.S. launched massive retaliatory airstrikes on dozens of Islamic Revolutionary Guard Corps targets in Iran. And I want to be very clear for our listeners here, we're remaining entirely impartial and just reporting what the sources state. According to the reports, Iran immediately retaliated overnight, striking U.S. bases in Jordan, Kuwait, and Bahrain.
Yeah, and they claim these strikes caused significant damage to logistical capabilities.
Which usually means targeting runways, fuel depots, that kind of infrastructure.
Right, and when you look at the immediate aftermath, it's tempting to view this kind of chaos as like an unpredictable natural disaster for the markets.
How so?
Well, it feels like a sudden storm you just can't model for, The map is red, oil is spiking, and the immediate reflex is just to brace for impact and sell risk assets.
I hear that, Mira, but I'm going to challenge that reflex a bit. It's not just random, unquantifiable chaos. If we look at this through a strategic lens, this is basically a textbook case of geopolitical escalation as game theory brinkmanship.
Meaning you see it as calculated, rather than a total loss of control.
Exactly. We've talked about this concept before, so we don't need to rehash the whole theory.
Okay.
But both sides are making highly visible, kinetic moves to demonstrate resolve. They're striking logistical targets, not trying to trigger a total, uncontained, asymmetric war.
But for the markets, that brinkmanship is still incredibly expensive.
Oh, absolutely.
It means the risk premium on everything, especially crucial oil transit lanes like the Strait of Hormuz, just skyrockets immediately.
And that geopolitical tension feeds directly into the nightmare scenario for global central banks, which that brings us to the Bank of England decision early this morning.
Right, at 7 a.m. Eastern Time, they voted 6-3 to hold their policy rate at 3.75%. But look at that vote split.
Yeah, that's wild.
You had 3 hawkish members voting for a rate hike right in the middle of a domestic economic slowdown. They are terrified of the second-round inflation effects from these exact Middle East conflicts.
Which perfectly illustrates central bank paralysis under supply-driven stagflation.
Right, and it's a critical dynamic to recognize here. The Bank of England is trapped. Domestic growth in the UK is weak, which usually dictates cutting rates to stimulate the economy.
But because global supply chains and energy markets are under attack, inflation threats remain high, which dictates raising rates.
Exactly. They are paralyzed. If they cut, they risk runaway prices. If they hike, they crush an already fragile economy.
And, as if the Middle East tension wasn't enough, right around 4:22 a.m. Eastern Time today, there was a report out of Eastern Europe that a Russian ballistic missile violated Polish airspace during an overnight strike on Ukraine.
Yeah, and Poland and NATO immediately scrambled fighter jets and activated air defense systems.
Which is huge, even though the Polish premier stated there was no reason to believe Poland was deliberately targeted. A direct airspace violation of a NATO member state is a massive escalation point.
Oh, for sure. When institutional investors see NATO scrambling jets in the pre-market hours, it elevates global tail risk hedging immediately. They buy put options, they dump equities, and they hoard cash.
So just to capture the mood, right? You wake up this morning, you have a hawkish Fed hangover, you have a paralyzed Bank of England facing stagflation, and you have active, kinetic military escalation across the Middle East and Eastern Europe.
The setup could not possibly have been more bearish.
It was an apocalyptic overnight backdrop. But then, about an hour before the opening bell, a single economic data drop completely flipped the script. So let's move to session 2. What moved markets during U.S. trading hours?
This is where the mechanics of the market get really fascinating. At 8:30 a.m. Eastern Time, the June Core PCE price index dropped.
And that's a big one.
It is. Now, as a reminder, Core PCE is the Fed's absolute favorite metric for inflation because it accounts for consumer substitution. Like, if beef gets too expensive and you buy chicken instead, PCE captures that reality better than standard CPI.
Right.
Well, that metric slowed to 0.1% month over month.
Which is an incredibly cool number.
It really is. And layered on top of that, advanced second quarter GDP cooled down to 1.5%, and weekly jobless claims were sitting right around 197,000.
So the market instantly spun this as the perfect Goldilocks scenario.
Yeah.
Not too hot, not too cold.
Exactly.
Inflation is cooling down, which the Fed desperately wants.
Yeah.
But GDP at 1.5% means the economy is still growing, just slowly. It's not a recession.
Right, and jobless claims hovering under 200,000 means the labor market is bending, but it hasn't snapped.
Right.
It gave the Fed the exact macroeconomic leeway they need to actually consider cutting rates. And the mechanism behind the market's instantaneous reaction is crucial.
Right.
Well, we often talk about risk-free yields as gravity compressing equity multiples. When inflation is hot, that gravity gets heavier, pulling down the value of future corporate earnings. But the moment that 0.1% PCE data printed, that gravity lifted. S&P 500 futures surged and the US dollar index tanked.
Okay, Daniel here pushing back on this a little bit, because this explanation always feels, a little too neat.
Fair enough.
Are we really looking at a fundamentally healthy economy here? Or is the market just playing a massive game of bad news as a Fed cut chicken game? The market is literally cheering that GDP cooled down.
That's a valid point.
If the economy actually starts stalling out, a 25 basis point rate cut isn't going to magically fix falling corporate revenues.
You're touching on the defining tension of this entire rally. Is the market celebrating health or just celebrating the medicine?
Right. I think a better way to look at it is like throttling a server to prevent it from overheating. The market isn't cheering for the server to break. It's just relieved it's not melting the motherboard.
Yeah, that makes sense.
They want the economy throttled just enough to get the Fed off their backs. But they're playing a very dangerous game, assuming the slowdown will stop exactly where they want it to.
That's a great way to frame it. And to that point, the executive branch actually stepped in mid-morning to massage this exact narrative.
Oh, really?
Yeah. At 9:17 a.m. Eastern Time, White House senior advisor Kevin Hassett went on television and publicly backed Fed Chair Warsh. He called Warsh a realist and explicitly said that the Core PCE print just made the Fed's job easier.
Which is fascinating, because you rarely see the White House commenting so directly on the internal mechanics of the independent Federal Reserve.
Very rare.
It was clearly a coordinated effort to erase the fear of a rogue, overly hawkish Fed that we saw yesterday. They wanted to assure the market that the Fed would look at this new data and act reasonably.
But while the White House was soothing the domestic picture, we had a major structural shock hitting the currency markets just after the open.
Right. At 9:35 a.m. Eastern Time?
Yes, the Japanese government and the Bank of Japan actively intervened to support the yen, and U.S. authorities simultaneously executed a rate check.
Unpack that term for us, a rate check. What is actually happening behind the scenes there?
So a rate check is essentially the central bank picking up the phone, calling major currency dealers, and asking for the price of the yen.
Oh.
They aren't necessarily buying billions of dollars yet, but it's a shot across the bow. It signals to the market, we are watching and we are ready to step in.
I see.
It often scares traders into unwinding their positions before the central bank even has to spend its own reserves.
And this ties back into something we monitor closely. Zero rate carry trades as a global liquidity vacuum.
Exactly. For years, hedge funds have borrowed Japanese yen at essentially 0% interest, converted it to dollars, and used it to buy high-yielding U.S. tech stocks. It's been free leverage.
Yeah.
But when the Bank of Japan forces the yen to strengthen, that trade violently unwinds. The debt you owe in yen suddenly becomes much more expensive.
So you get a margin call.
Yes. You suddenly have to sell your U.S. tech stocks to cover your yen debts. That intervention today drove the dollar index down to close at 99.98, and it creates a global liquidity vacuum where cash gets sucked out of equities to cover currency positions.
So you have this currency intervention threatening to pull liquidity out of the market. But right around 10:43 a.m. Eastern Time, we got a diplomatic breakthrough that eased a massive pressure point on the global economy.
The summit.
Yes, Saudi Arabia hosted a 43-nation summit, and 14 countries signed on to create a maritime defense alliance specifically to protect shipping in the Red Sea and the Bab el-Mandeb Strait.
And that directly targets the stagflation fears that were paralyzing the Bank of England earlier. The threats from the Houthis to impose fees and seize tankers had sent oil prices soaring.
Right. I mean, Brent crude hit an intraday high of $93.14 today.
But the moment that coalition was announced, oil started cooling off, eventually sliding all the way back down to close at $89.45. We have to remember that oil shocks act as a multi-channel corporate margin tax. When oil spikes, it raises the cost of manufacturing, packaging, shipping, and insurance for every single company in the S&P 500.
And maritime insurance is a huge part of that. If ships are getting attacked, insurers either refuse to cover the voyage or the premiums jump so high that it ruins the profit margin of the cargo.
Exactly.
A 14-nation naval coalition physically protecting those lanes instantly drops the risk premium. It acts as a massive tax cut for global supply chains.
Which is exactly why the broader market reacted so positively.
So the trading day was essentially rescued by two macroeconomic pillars: cooler inflation data that lifted the gravitational pull on equity multiples, and geopolitical stabilization efforts that brought down oil prices.
Right.
We're going to take a short break, and when we come back, we'll dive into the mind-blowing corporate numbers that fueled the tech sector's resurrection today.
Stay with us.
All right, we are back. Moving into session 3, what is the corporate events recap and what should we watch next? Even with all that macroeconomic help we just discussed, the Nasdaq wouldn't have rallied 1,100 points without some absolutely massive corporate news.
Oh, absolutely. Following the market close on July 29, the major tech players released their numbers. And today, the market spent the entire session digesting the sheer scale of their plans.
Yeah.
It is nothing short of a big tech AI Capex supercycle.
The numbers in our sources are almost difficult to comprehend. Microsoft disclosed that its uncommenced future lease commitments spiked to $329.1 billion.
Unbelievable.
Just to put that in perspective, that is up from $197 billion previously.
Let's break down what an uncommenced future lease commitment actually is, because it sounds like accounting jargon, but it's actually physical reality.
Right. This isn't just Microsoft saying they might buy some software licenses.
No, this is physical infrastructure. When they sign an uncommenced lease, they are locking up land rights. They are securing power purchase agreements from energy providers.
Wow.
They are legally committing to pour concrete and build massive data centers that haven't even broken ground yet. It is a legally binding commitment to future capital expenditure.
And Meta wasn't going to be left behind. Mark Zuckerberg's company disclosed future spending commitments of nearly $700 billion. Let me say that again, $700 billion.
What's critical here is how the market processed this. Historically, when a tech company announces massive capital expenditure, Wall Street punishes them because it crushes their free cash flow in the short term.
Yeah, usually.
But today, the market looked at those numbers and saw a guaranteed locked-in demand.
Because if Microsoft and Meta are committing over $1 trillion combined to physical AI infrastructure, that means the semiconductor companies, the server manufacturers, and the liquid cooling providers all have guaranteed revenue for years to come.
Exactly. That realization is what fueled the Nasdaq's resurrection today. Investors aggressively bought the company supplying the picks and shovels for this AI gold rush.
But I do think we have to acknowledge the shadow hanging over this. We have discussed the danger of AI Capex as a self-referential valuation loop before.
Yes, we have.
Tech company A buys billions of dollars of chips from tech company B to train models that they lease back to tech company C. They use this massive spending to justify their own sky-high valuations, which they then use to raise more capital to spend on each other's products.
It's a massive feedback loop.
As long as the music is playing, the valuations go up. But if the actual end-user monetization, like selling the AI to non-tech businesses or regular consumers at a profit, doesn't catch up, that loop can break down very quickly.
And we actually saw a localized preview of what happens when that loop breaks down today. Just before noon, at 11:32 a.m. Eastern Time, it was reported that Citadel had to step in and execute a multi-billion-dollar bailout.
Wow.
They bought a massive block of AI tech stocks directly from a struggling hedge fund.
The mechanics of a block trade like that are fascinating. Citadel basically steps in and buys the entire portfolio privately off the open market.
Right.
Because if that hedge fund's prime brokers had been forced to liquidate those billions of dollars of AI stocks on the public exchanges, the sheer volume of selling would have cratered the prices of those stocks for everyone else.
It would have triggered a chain reaction of margin calls across the street. The Citadel intervention successfully prevented a broader systemic liquidity contagion.
Yes, but I have to share the name of this fund with you, because the irony is just too perfect. The fund that blew up on highly concentrated leveraged bets on AI stocks and had to be bailed out to prevent a market crash was literally named Situational Awareness.
You cannot read better irony than that.
You really can't. So, to celebrate the 1,100-point Nasdaq turnaround today, let's just raise a glass to the hedge fund named Situational Awareness, which had to be rescued by Citadel after completely losing track of its own AI bets. I guess their algorithms were brilliant at coding, but severely lacking in actual situational awareness. If you manage to survive today's wild commodity and equity swings without getting margin called, congratulating yourself, you officially have better risk management than a multi-billion-dollar quantitative fund.
It's a funny note, but it highlights a very real systemic risk. When trades get that crowded and that leveraged, the line between a market rally and a liquidity crisis is razor thin.
Absolutely. So looking ahead to tomorrow, Friday, July 31, Mira, what is on the calendar that we need to be watching?
It's a heavy day today, so keep your eyes peeled. First up, at 8:30 a.m. Eastern Time, the Q2 Employment Cost Index.
A big one.
It is arguably the most comprehensive measure of wage growth because it includes benefits, not just hourly pay. It is a critical input for services inflation, and it will directly impact how the market prices in those potential Fed rate cuts.
Then at 9:45 a.m. Eastern Time, we get the July Chicago PMI, giving us a read on regional manufacturing health.
Right. And shortly after that, at 10 a.m. Eastern Time, we get the final July University of Michigan Consumer Sentiment Survey. That's always closely watched to see if everyday consumers are baking higher inflation into their long-term expectations.
And finally, throughout the entire session tomorrow, be aware of month-end portfolio rebalancing flows. Large funds will be adjusting their asset allocations, which can cause weird volume spikes.
Very true.
Plus the continuous overnight headline risks regarding the U.S. and Iran retaliation cycle. The geopolitical map is still incredibly fragile.
Today proved that the volatility we are seeing is not an anomaly. It is the new baseline.
So what does this all mean as we close out today's deep dive? I want to leave you with a final thought to mull over.
Okay.
The entire architecture of today's massive stock rally relied on a very delicate balancing act. The market needed consumer spending and inflation to slow down just enough to appease the Federal Reserve, but not enough to trigger a recession. But if big tech is now committing nearly $1 trillion to future AI physical infrastructure, buying up land, draining power grids, hoarding semiconductors, at what point does that massive localized capital expenditure single-handedly reignite the exact inflation the Fed is trying to cool?
Wow, yeah.
Can the broader macroeconomy safely cool down if Silicon Valley is running at 1,000,000 degrees?
That is the multi-trillion-dollar question going forward.
It really is. We'd love to hear your take on that and on all of today's massive swings, so please share your thoughts in the comments.